Welcome back to the channel, everyone, and thank you for tuning in to another great video. Today we're going to talk about and discuss and even break down what retail traders see versus what the big banks are trying to accomplish. You have to understand what the institution's overall goal is. Bottom line here, we're going to talk about liquidity. Are we running buy stops to the upside or looking for opportunities to take out sell stops? That's all the institutions, quote unquote, the big banks are looking for. You have to understand that piece. The sooner that you do, all right, the quicker that you're going to be able to profit and make money, all right, as an experienced, as a beginner or new level trader, okay? So let's talk about what retail traders see, all right, versus what the big banks do, okay? So I want you to take a look and focus on just today's session, all right now, and then we're going to go back and I'm going to explain some things. Now, yesterday we saw the market doing what? Running to the upside, all right, making higher highs and higher lows. Now, I always talk about confirmation and confluence from the higher time frame, all right, and I'm a supply and demand style trader, okay? Now, there's a couple things I look for, as you always know, when it comes to my step-by-step process. It's always a break of structure, pull back to a key area or zones of supply or demand, looking for the rejection, boom, take the trade, right? But you also have to encompass what's truly going on from the bigger picture. What are the big banks really trying to do in the end-all scheme of things, okay? Now, it is their goal to do what? To stop traders out. That's all they're interested in doing, is stopping us out, okay? They are looking to take positions, fill orders, and stop us out, okay? All right? So, and they look for opportunities within the market to be able to do so. Now, we as retail traders can identify their moves based on big areas or big moves in the market, so that if there's a big displacement or a big push in one direction or the other, either up or down, okay? And as retail traders, we look for price to do what? To retrace back to a key zone. All right, if it's pushing hard to the upside, we get a massive displacement to the upside, and then price pushes back or pulls back to a demand zone. We're looking to do what? Go long. But we want to see areas of liquidity to be taken out. Yes, liquidity. Okay, understand that. Because that is, in the grand scheme of things, what drives the market is money rested at key areas or key levels. Okay, so let's take a look here at today's session. All right. I saw yesterday as the market was closing, okay, this area right here, the market did what? A lot of people will say that this is an area where the market is consolidating. Yes, it was. But also what you see here is that the market was wicking higher, okay? It must have hit some area to the left-hand side up here, which was an area where there was big displacement or big push to the downside, okay? So there's a supply zone sitting up here. Okay, the market started running lower, and that's why we got this big push to the downside with these lower lows and lower highs. Okay, now, so and seeing what was going on here, the market consolidating, it started pushing up, pulled back, it wicked out, and couldn't push any higher. Now, to me, that stands and shows me that it signals to me that the market is possibly trying to do what? Reverse when we see means of consolidation. Okay. What I do is I'm not looking to jump in any trade at any particular time, okay, at this moment. I'm looking to see, are they done or finished what they're trying to accomplish here. When I start to see the market start to wick multiple times, again, this is possibly a setup for the market to reverse. Now, I'm not saying the market's going to shoot all the way down and start taking out all these sell stop orders down here where there's resting areas of liquidity. But what we can do is look for an opportunity, what's called a market shift. A shift in the market, okay, to where the market may push lower. My first trade setup today, okay, was an opportunity where I saw price running lower, okay, all right, and then I saw liquidity being formed right here at the bottom, meaning equal lows right here, all right. These are sell stop orders. And what I saw and identified even into yesterday's trading session was this big push to the upside. Lots of buying, okay, to the upside, all right? These are what traders put on positions to do what? Drive the market higher, okay? Now, when traders trade, say for example, and push the market higher, then the market turns around, all right, and there is equal lows being formed right here. Again, these are sell stop orders. So basically what happens is, as traders are pushing the market higher, the market pulls back, they are repositioning their stop placements or their orders to where they are looking to possibly continue taking a ride to the upside. So they are moving their stops to the upside, okay? And that's what the institutions are really trying to do, is to run stops. So when the institutions see opportunities right here where there are equal lows being formed at, which to them signals sell stops or sell side stops right here, what do you think their goal is going to be? They're going to want to run those stops because they know traders were pushing the market. We're aiming to see the market push higher. The market was already pushing higher. They were repositioning their stops as the market pushed higher. Now there's an area of liquidity being formed in the market, and you have to be able to see this with your own eyes, guys. I mean, it doesn't take much experience to be able to identify higher lows, not higher lows, equal lows and equal highs, okay? That just signifies areas where liquidity is being developed or positioned or built within the market, okay? So what retail traders will try to do is, when if you're not already in a trade moving to the upside here, okay, and you're taking this nice ride to the upside, right? And if you're not in a position yet where you've already entered long, then what you're going to be looking for is, as a retail trader, is where the market pulls back, okay? You consider this, if you're a support or resistance style trader, you consider this as what? An area of support. So when the market pulls back to this area, you're looking to do what? Go long. Because you see that the market is bullish, okay, coming out of yesterday's session, and it's been breaking to the upside, taking out all these buy stops right here to the upside, meaning taking and breaking through levels, okay? So you look and think that the market is going to what? Continue pushing higher, all right? Now, it possibly could. But the difference in what the institutions see here, they see opportunity. They see liquidity being formed right here. They see stop orders placed right here, okay? Okay, those traders that were long are repositioning their stop orders resting right here. So they see that formulation or form of money resting in the market right here. So where retail traders waited for an opportunity to pull back to go long, institutions were gauging and looking for to take out this area of liquidity right here and hit those stops. That's what makes the difference of a retail trader and the big banks. You have to understand. And we want to be able to move with the institutions, not against them. So if you were a retail trader and you took this opportunity to go long here, you got railroaded to the downside as the institutions were looking to take out this liquidity right here, all right, and run these sell stops right here, okay? So look for those areas in the market to where there are buy stop and sell stop orders. Buy stop orders are you're going to see where there's equal highs at. Sell stop orders are you're going to see where there are equal lows at, okay? And look for and wait for the opportunity to where the markets, where the institution or banks are looking to take out these areas, whether it's here, okay, this was sell stops, right here, buy stops. So today I got into a trade, okay, and then we're going to look at an example, okay, of what I'm talking about also when it comes to what the retail traders, where they make the mistakes at versus what the big banks, the institutions, what they look for, you know, what are their aims, what is their goal. We're going to look at some other opportunities, okay, or some other examples of what they saw, okay. So what I saw was when the market broke lower and took out this area of liquidity, I know the big banks were involved in that movement to the downside. But look what happens here. They didn't continue running the market lower, okay? A lot of people would think that, okay, institutions or the big banks took out liquidity here. They must go to continue taking a ride to the downside to take out and hit these other areas of sell stops. Possibly, okay? At some point, they will do that. But what I saw right here was after they took these stops or hit these sell stops right here, ran those orders to the downside, what I saw next was, okay, the market starting to do what? Develop or build an area of, if you want to classify it as support, you know, which support resistance style traders will call it that. This was an area where liquidity was being formed, meaning equal lows right here, okay? So we got sell stop orders being placed right here as well, okay? When I saw this accumulating in this area right here, okay, so the market came down, pushed up, pull back, equal lows right here, and then we got displacement to the upside right here, right? A big push to the upside, all right? So I knew who was putting on those type of orders, okay, or entering the market. It was the banks, guys. You have to understand that. So as retail traders, we want to follow the movement to the upside with them. And what I said was, okay, so they're not looking to come back down here and take out these sell stop orders right here. What they just did was liquidity or base was being drawn right here. All right, they didn't want to come back and take this area here out. What happened was we had a push to the upside instead. Big displacement, major push to the upside. When you see big moves like this, all right, I'm not talking about where you have a push to the upside, a pull back, and then one candle break above. Big displacement or big push to the upside where you see multiple candles breaking above a prior, swing high right here, break above. Look for a pullback to take a continuation trade, but also look before you get into a trade to see is there any area that they may be gauging. Right here, these were buy stop orders. So just as I mentioned, there were traders that were yesterday positioning trades to go long here, okay? And as the market pulled back, all right, and we saw liquidity start to be in a base started to be forming liquidity with these equal lows at here. All right, these were sell stops, okay? So at some point, the institutions are going to take it out. Same thing on the flip side. We came up here, market couldn't push any higher. Traders started, entering the market and driving the market or, push lower, okay? So traders started selling as the market pushed lower, okay? So what happened here was then, all right, we start to see buy stop orders being placed, equal highs right here, all right? So these are just areas where those that went short, okay, were looking to reposition their stops as the market, can try to push higher. They were moving their stops to areas so they wouldn't be stopped out, okay? All right, understand that, all right? So they were going short here. The market started pushing higher. They were bringing their stops, bringing their stops lower, okay? So that they could capitalize on some means of profit, all right? So that means that there are buy stops being formed here, okay? Liquidity is being developed or built in the market. So when I saw this area right here, okay, we got the rejection to push lower right here. Liquidity base being formed right here. Again, a liquidity base being formed right here. Pushed to the upside by the institutions or banks, pulling back, okay? Now, it did pull back to this area right here, okay? When it first made this push to the upside, it came back. It felt a little, there was really no imbalance right here. It came quickly back to the basically this demand area right here, okay? But it really wasn't classified as a full-on demand area until we got the break to the upside, meaning breaking structure, taking out this high right here. But it had already pulled back, leaving no area of imbalance is what I'm trying to say at the demand zone. But what we did have when it pushed higher, it left a fair value gap in between this candle here, the push break or the break above that candle right here, and the next candle that closed. So it left a fair value gap right there. So what I waited for was a pullback to the fair value gap area, a close above, and continuation to go long to take out the buy stops here and move in the same direction with the institutions, the big banks. Understand that, okay? And if you were into a trade in doing so, it did indeed move higher, took out the stops here, okay, and it pushed a little higher before it pulled back. So you have to understand that the big banks, they are chasing, not saying chasing, they are in a sense, and want to hit areas and take out either buy stops or sell stops. Those are areas of equal highs, equal lows, or basis of liquidity, okay? That's what they're chasing, guys. That's what their aim is to do in all points, is just to take those areas out because they know you and me as retail traders, okay, have repositioned their stops at some point. So again, if we're short here, we position and brought down our stops right here, and then a base is being drawn right here to where traders are they're constantly going up and testing areas, okay? Areas where they know, say for instance, retail traders are move their stop losses. So boom, a base, boom, a base, boom, a base. So a liquidity base is being formed right here. Okay, all right. So Then the market unfolds to the downside as, you know, same token. Where there was liquidity being formed right here, it was being formed on the bottom end. And eventually they're going to take that area out, run it back to the upside, and take out those buy stops. I'm trying my best to explain this so you guys understand what's going on. Because you want to be able to look for those areas of what you could call liquidity pools in a sense. And those are just areas where there are buy stop orders being placed or sell stop orders being placed. Understand that, all right? So if we take a look here to the left, so you may be asking, okay, to me, okay, well, what could possibly take place now? Well, we got sell stops down here, okay? We've got a liquidity pool base at the bottom down here as well, okay? So this is where the run to the upside took place here, and the market was making these equal lows right here. So at some point, it's going to come down, take out those lows right here. And then again, at some point, it's may push lower and come and take down these equal lows down here at the bottom with their sells and run these sell stops. Understand that. That is what the institution's aim is. That's their only aim, is to stop retail traders out, okay, on a basis where there are areas of liquidity pools, okay? Understand that, or a base of liquidity. All right, so take a look here. What I want you to identify and be able to look for is, for one, are there areas where the market formed a base, okay, and it didn't want to push any lower? Liquidity being formed right here, all right? Sell stops right here, okay? And coming out of that, was there a big push to the upside? Yes, there was. Then look to your left-hand side of your chart and see, was there any means of where there's buy stops at? A liquidity area, okay? Yes. So if we get a push to the upside, price couldn't run the lows any lower right here, and it started building a base right here. We get a big push to the upside, meaning the institution stepped in. Look for a pullback to go higher or to go long and take out the first area of liquidity back to the upside. Understand that, all right? So let's look here to the left-hand side of the chart. I want you to see this in the previous day session, all right? I'm kind of drawing out and making this video a little longer than I wanted to, because I'm trying my best to really explain, you know, what the big banks are focusing on, what they really want to do in their moves to capitalize in areas where they're looking to take traders out, okay? All right, when talking about retail traders, you and me, all right? So let's take a look at yesterday's trading session in the prior, and also the prior day, which was, I believe, was the 25th, okay? So take a look here. We see where the market, say for instance, made a low right here, right? All right, it pulls back, and then more selling activity comes into the market, right? Okay, so which means sellers stepped into the market. Then the market does what? It starts pushing to the upside here. It pulls back, pushes higher here. It does what? It makes an equal, or makes equal highs right here, okay? Now, what's causing this liquidity to be actually being developed or built within the market here? Well, it's sellers that sold right here, okay? And as the market starts to push higher, they are repositioning their stops so they can take profit at some area. They're not looking to get stopped out, all right? And, you know, those that are able to capitalize and reposition their stops, at some point they're going to go ahead and get out the market or be forced out of the market by the institutions, because they're going to run the market higher and want to start taking out areas where they see liquidity pools being formed at, all right? Meaning buy stops in this area right here. They're going to want to take those areas out and then push the market higher and take out liquidity ultimately at the top end, which is these highs right here, okay? All right, and those highs are come off of this push to the downside right here. So when we see the market start to shift and turn back around, where it made a high here, a pullback, and then a similar high right here, all right, then your mind should start shifting. Okay, there's liquidity being built in the market. There was selling activity here. Now there's buy stop orders right here. Those same sellers that entered the market, they are bringing down their, you know, their stop placement in a sense, so that they can start trying to you know, not being stopped out at some point. Now, at some point, you know, if you kept trying to forcibly sell or get into the market thinking that's going to push lower, you got ran, okay? And you got stopped out. You got railroaded, okay? So, again, this area right here is an area where buy stops are right here, equal highs right here. So when the market pushed back or pulled back right here, okay, there was actually, you can see a push to the upside right here out of this demand zone right here, okay? Now, it didn't like just blast to the upside and just, you know, with displacement and with several candles formed after taking out, say for instance, this high right here. But this area right here is aggressive buying to the upside, all right? And eventually it took out these equal highs right here. So I, as a retail trader, and knowing and looking for this aggressive buy opportunity or buying to the upside right here, all right, and knowing these are areas where buy stops rest at, and knowing this is a liquidity area that's formed right here, I got to start thinking that the institutions are going to do what? Take out this area. All right, they pushed the market and drove it higher here, aggressive force to the upside. So why not look for an opportunity on a pullback, okay, specifically to this demand zone here? Now, yes, price didn't come back tick to this demand area right here, but it did fill in a fair value gap area right here. And sometimes the market will do that. It may not come back tick to a demand zone, which is right here, but it may come in and want to start filling in a fair value gap area, all right? And if it does so, that's still opportunity to take a trade long if you get rejection, break of the candle in the opposite direction. We get that here. So this is why the market ran higher yesterday. So let's say the market pulls back, fills in this fair gap, comes back to this fair value gap area right here, okay? And then it rejects the area. Doesn't close in it, rejects it, wicks right here, closes above. You got into a trade right here. You're going to do what? Aim for the high right here at 90. So if you got in here at 85, you got out at 90, you pick yourself up 5 points. And then the market does what? It just blasts to the upside. Why does it do that? Because it's aiming for other areas of liquidity back to the upside here, especially right here, this high right here, where additional selling to the downside took place. So out of this leg to the downside right here, okay, there was a lot of selling that took place here, and there were areas of liquidity that the market was aiming for to take out back to the upside and capitalizing on this high right here, because again, these were equal highs right here, okay? Major area of liquidity that needed to be ran right here, all right? So let's look at this area here. I believe this may have been the 26, I believe it was, guys. I'm sorry. Let me take a look and make sure for sure. Now, okay, let's look at the 26. Okay, we see areas of the market is pushing what? Making lower lows and lower highs. Let's focus on the 26 right here, okay? Because there were opportunities to, even within this swing to the downside right here, okay? There were opportunities to do what? To go short, all right? Because I want you to pay attention here. When the market started, it made this low right here, and then it starts to do what? It starts to make higher highs and higher lows to the upside here. So, you know, as you can see here, high, higher low, higher highs, higher lows, and then we get this big push to the upside here, okay? Now, who do you think made that type of move to the upside? Okay, the big banks, all right? But as it's drawing itself to the upside, look what's taking place here. We've got a push here, pull back, push here, pull back. It's making equal lows right here. So this is an area where there are where liquidity rests at, right here, okay? All right, so when the market pushes up here, we got a big push to the upside here. Then the market turns back around and takes out this area right here. This is a break of structure back to the downside, okay? And we got a big area of a powerful push to the downside right here. Who do you think did that? The banks or the institutions. Lots of aggressive selling to the downside here. So what they do, they ran liquidity. They ran sell stops right here, all right? And as retail traders, what we can look for within the market is opportunities to where we see sell side stops being taken out, okay? Meaning equal lows, all right? Areas of liquidity to where they're followed up with, say for instance, for one, let's do this right here. All right, so we see these sell stops right here, right? We see these equal lows right here, right? The market turns around and we get a big push to the downside. That's number one. Look for that massive means of displacement or big push, powerful move to the downside. And you have to think to yourself, who's making that move? The institutions. So if the institutions are making powerful moves to the downside in this example right here, then you have to get to thinking as a retail trader, all right, they're the ones that made the powerful move. They just ran liquidity. Let me look for an opportunity on a pullback, because more than likely there are still orders that didn't get filled on their end. Okay, we want to trade as retail traders with them and think like them. So if they're placing orders, stockpiling on lots of orders, then at some point when you see a powerful move like that, some orders got left behind, and they have to get those orders filled. Okay. So the market pulls back, okay? Now, it could have pulled back to this area right here, but you also have to keep in mind that there was also a supply area right here, aggressive selling to the downside right here, okay? And there's a gap right here or an imbalance, all right? So we look for, if the market can't reject this area, definitely get back up here. So sometimes what will happen is, even though we got aggressive selling to the downside right here, okay, and there's a gap right here, they'll fill this area here, bypass it, and push up to the next area above. So be ready and be mindful of things that take place like that. So the market pulls back to the zone right here, okay? Now it didn't 100% tap into the supply zone, but it taps into the area of imbalance right here. You get the rejection, take the trade going short with the institutions, the big banks, back south, okay? Selling off again, okay? They've got to come back up here and fill in the rest of those orders up there, okay? So, like I said, there was an area of liquidity. They aimed for it, okay? Major displacement or push to the downside. Then look for the pullback to the key area where maybe where the displacement started at, or the push or the origination of the move started at, the big push to the downside. Pull back, retracement back to that area, wait for the rejection. Again, it could come back or pull back to the supply zone here, or within the imbalance where there's a gap at, and then reject that area as well. Let's take a look at the last example here, okay? I know I may be getting a little bit tongue twisted here, guys. I'm kind of excited and talking to you guys about this, and so you can grasp it, all right? Always look for a big push, okay? Coming out of a swing. That's displacement, if you want to call it. I don't like to get so much involved in all the technical terms of things, but I just keep it simple. Big push, all right? Lots of aggressive selling or buying, okay? Coming out of a level or zone, well, a level, okay, which creates the zone, okay? So here we go right here. I mentioned there were sell stop orders right here, as well as sell stop orders right here. Why? Okay? Tell me why, all right? Well, let's talk about it. What do we have here? Is the market was pushing lower, all right? It created a base of liquidity right here. Push down, equal lows being stacked right here, okay? Now, we know at some point they're going to want to run those areas. When we talk about we're talking about, again, the big banks, okay? So, or the institutions, quote unquote, okay? So, the market does what? It comes down, okay? It takes out liquidity. What do we see? We see a push down, a pullback, massive, powerful move to the downside. Did me and you take that trade? Did me and you make that happen as retail traders? No, no. We do not have the capital to make aggressive moves like that and keep the market just powerfully pushing to the downside. What does it do? It takes out liquidity, okay? And then this is where we have to think as retail traders what and where we can get into the trade at. On the retracement. The swing to the downside, the aggressive selling, wait for price to pull back to the key area of supply where the market started originally pushing down, right here. Now, we have, again, an imbalance back at a supply zone right here. It pulls back to it, okay? And maybe you got into the trade right here. It didn't immediately, it didn't hit the zone or tap into the zone, nor 100% feel. Let's see here. Let me adjust this just slightly because this is the actual imbalanced area. If you see right here, there's a very little gap right here, very small gap right there. It didn't hit it, but there was a fair value gap in this area right here from, well, this candle here closed and the next candle that took it out to the downside. There was a gap right in this area right here. You could have gotten through the trade possibly right there, waiting for the rejection, closing the candle to run to the downside and take out the low right here at 74.25. But if you waited for price to tap back into the imbalance area back at the supply zone, then this is what unfolded right here. Price came down, okay? First, when it pushed down right here, okay, it pulled back, pushed lower right here. It made equal lows right here. Even though it took out this low by wicking out, it still can be considered a equal low. Even though the low may be gotten ran slightly, this is considered an equal low, guys, because it did not fully close below it and push lower. So we've got an equal low, another area of where liquidity is being formed. So it made a low, pushes up, equal low here, runs higher, taps into the imbalance and the supply zone. You get the rejection, boom, close the candle at the rejection, take it lower, aiming for here. Now where this base of liquidity is right here, we got a low here, low here, low here, taps into the zone, break, and then boom. This is your shot to take the entry going short. Close the candle in opposite direction. You can see it right here. Consolidation, wicking out right here. Close the candle in opposite direction, down to the downside, run the lows right here. So let's say it pulls up, you got into the trade, I don't know, somewhere along the line. Let's say for instance on the safe side, you got in right here at 80, okay? At 80. And maybe you got in a little bit earlier, back up in here around 82, maybe 83, okay? The market started consolidating right here. And for me, I would probably be getting to the trade. Let's see, it pushes up, pulls back. Yeah, I probably would have waited and got to the trade right here around 82, okay? And maybe a little bit more conservative and you got in here at 80. All right, still look, if you got in here at 80, take the trade all the way down here to take out this area of liquidity, okay? Run the lows here, hit these sell stops right here, and you're 72. So you pick yourself up almost 8 points right there. Nice, beautiful trade. And actually you did, because if you stayed into the trade, it actually gave out more than just that. It went all the way down here to 60, say 69, okay? So these are the type of things that you really need to look for. You need to look for those areas of liquidity being developed. Equal lows or equal highs, okay? If it's at the top side where price is pushing higher, pulls back, pushes higher, can't break through, it's creating a liquidity base at the top there, those are buy stops, okay? And if it's doing it from below, then those are sell stops. At some point, price is going to test and run those areas of liquidity, the buy stops or the sell stops. So look for areas in the market like that, okay? That's the best way I know how to really explain it to you, and hopefully I did my best in trying to explain it to you. But if you found the information in this video very valuable and helpful, please, right now, take the time to drop a like on the video for me. Thank you for doing so. If you are not a current subscriber here on the channel, I highly recommend you hit that subscribe button down below, because there are tons of videos here on this channel to where, you know, you can basically learn or grasp or absorb the information I'm trying to spoon feed and push out there to the community to help fellow traders out. That's my goal, guys. That's the aim of what I'm trying to do, is to inspire other traders as well. So please take the time, if you're not a subscriber, by clicking on the red subscribe button down below. Make sure to turn all your post notifications and click on the bell next to the sub button. Thank you for doing so. If you're interested in joining our Discord community, you can find the link down in the description portion of the video. There's a link down there. Invite yourself in. We have a great community of fellow like-minded traders. There's a channel on the Discord. It's called Trading Floor. That's where we as traders come together and we post screenshots of our entries and discuss trades as well on the Discord community. So if you're interested in joining, find the link down below. If you want a further means of explanation, you want to receive the trade breakdowns of my trades when I post them. I do live trade sessions, well, recorded live trade sessions, I say, but they're actual trade sessions where you can actually see me trade live and I go into detail about things. But if you're interested in receiving the full breakdown of my trades, become an elite member today. All you have to do is click on the join button. Yes, the join button on any video or back over on the homepage as well. You'll see two tiers there. If you become an elite member, you get the trade breakdowns, the video playlist, to where I basically hand select the videos that I feel aid traders along in regards to my means and strategy of how I trade. So please, all you got to do is click on the join button. By doing so, basically what you're doing is you're supporting the content that I am pushing out here on the channel. So you're supporting a content creator by simply subscribing to a $6.99 month, tier level subscription, okay? That's basically a price of a cup of coffee, which you would spend daily. $6.99 is all you're going to spend a month to get the trade breakdowns. And, you will learn. You will grasp it and absorb the information, hopefully, what I'm trying to put out there, okay? I'm not an educator or a mentor. I don't have a training program. And so right now, that's the best means of what I'm trying to give to this community here is my trade breakdowns. I want people to understand, because I basically walk you through the setups. You get the in-depth mind frame or understanding or grasp the understanding of what I'm thinking leading up to a trade and before I take the trade. And I discuss in detail why I took that trade. So that has helped tons of traders out, and I appreciate everyone who's currently signed up to become an elite member, I thank you for doing so, because you have constantly sent me comments, DMs, letting me know and thanking me for providing the trade breakdowns and going over in depth, as well as the videos that I create, going over in depth the material that I go over. So again, I thank everyone currently subscribe to the channel. Please take the time to sub if you haven't done so. I'll see you guys in the next video. Yes, it's long-winded, but I wanted to break things down so that you get a better understanding of what to look for, okay, and not be blindsided or railroaded by the institutions or big banks.